Hi, I'm David Phillips, and I'm the CEO of Estate Planning Specialist. And I'd like to talk to you today about something that is extremely serious in our country. In fact, it's a crisis. But before I get into that, I'd like to tell you a story. When I was growing up in California, in fact, Carmichael, California, Northern California, in the 50s, one of the big crazes that we had as kids was to collect baseball cards. And we'd go down to the corner grocery store, and they had a little gumball machine that actually you'd put in a penny, you'd get a gumball, and you'd also get a baseball card. And sometimes the baseball card was a precious card, and you could use it to trade for Willie Mays or somebody you really, really cared for. But most of the time it was just minor league players. But everybody wanted the coveted Mickey Mantle card, and they were so rare. In 1956, in the summer of 1956, I really struck it rich. I put my penny in the machine, turned the crank, down came the gumball, and out came the card slowly. And I could see the Yankee logo. I started to shake with excitement, thinking, could this be it? And sure enough, as I pulled the card out, it was Mickey Mantle. And I learned that day what the concept of leverage was all about. For a penny, I walked away with the Mick, the greatest prize of all in 1956 for a baseball card collecting kid. That card today is worth over $1,300. Now that's leverage. And that's what I want to talk to you about today, is leverage. How you can take a penny today, a dollar today, and create enormous leverage to take care of and prevent the crisis that is in our country today. I'll guarantee you that everybody that's listening today has somebody that they know that has been impacted by a long-term care event. Grandma, grandpa, father, mother, brother, friend. And each one of you have seen what a long-term care event can do financially to those individuals. Well, this is a crisis in our country because people are living longer, obviously, and as a result of living longer, they need to have somebody to take care of them, especially if they become frail. The problem that we have is that only 5% of Americans ever done anything at all about taking care of something that will impact 72% of those of us that are over 65. In fact, 80% of women will have a long-term care experience if they're over age 65 today. Well, that's huge. In fact, 91% of all married couples will have a long-term care event if they live past 65. So this is huge. It's a problem. And how do we do that? How do we take care of it? Well, traditional long-term care really wasn't the answer, obviously, since only 5%. Why didn't more people jump on that bandwagon? It was because it was a use it or lose it proposition. If you never used it, you never got any money back. It's like car insurance or homeowner's insurance. And yet the probability of your getting into an accident is 18%, where you lose your car totally. The chances of a long-term care event are 72%, so it's a lot higher probability. So you really need to take care of this. But why haven't we done this? Why have we put our hands in the sand and just kind of forgot about it, hoping that, it's never going to happen to me, it's going to happen to somebody else? And yet statistics say that it will. Well, the reason why we haven't done this is because I believe the best way to approach this had not been created until now. And the product that I want to talk to you about today, the concept, the way to take care of the strategy to take care of this, is called return of premium long-term care. And that particular concept is explained in my special report that's available at no cost to any of you that go onto our website and log on to it and ask for the report. And you can also call our toll-free number if you would like, and we'll send you the report at no cost. Send you the report. And it explains this concept in detail. But what is it? Well, it's leverage. It's using the same kind of leverage that I was talking about with Mickey Mantle and the baseball card. It's taking $100 from your left pocket and transferring it to your right pocket. It's still an asset on your balance sheet, something that you can have that's yours. And nobody can take this away. This is this is an asset on your balance sheet. And should you get into a situation where you cannot perform 2 of the 6 activities of daily living, or you become cognitively impaired, that $100 expands immediately at a minimum of 3 times to $300. And over time, it actually grows, and so it can be as high as 10 times what you put in. In the meantime, should you never trigger the long-term care bullet, which is really what we want, we want to dodge that bullet. Should we not have that experience, all of the money that I put into the plan is returned to my beneficiaries. All of it. So if I never use it at all, somebody gets the money back. And that's the key to it. But in the meantime, I have this tremendous leverage that's been created that I can use for my care if I want to. David, what's so special about the return of premium long-term care plan, and why do you think this is the best one? Well, first of all, and I think this is the most important concept, is that if you never ever use the long-term care, as I said earlier, you get your money back. Your family gets your money back. And if you need it for care, it expands that $100 3 to 10 times what you put in. That's why it's special. But there is a particular product that we really, really like. And it's being offered currently by an insurance company that is Comdex rated 95 plus, which is very, very difficult to get today in the ratings. So it's a really, really highly rated 100-year-old company that has this plan. And we've done all the research. My staff has researched every plan that's out there, and we've determined that this particular plan gets you the biggest bang for your buck. And so it actually creates more leverage than some of the other plans that have been out there for quite a while. We know who this is, and we explain and we'll uncover for you who that company is and what that product is in our special report. And so all you have to do is go to the website or call our toll-free number, and we'll send you the report at no cost. And it'll tell you who offers this plan. The other thing that you're going to want to do is you're going to want to get a personalized example analysis of what this plan would look like for you, specific for you. We'll talk more about that later. Another question that I seem to get is, what is the difference between plans? So you have one plan that's over here, one plan's over here. What's the main difference? Well, benefit-wise, the plan that we recommend is about 25% more in benefit than the average in the other plans that are out there. So that's a big difference. But the major difference is that the plan that we're talking about, we call it return of premium long-term care, is that it offers an indemnity benefit versus a reimbursement benefit. Now, why is that a big deal? Well, first of all, what is indemnity? Indemnity is a way in which the insurance company pays out the benefit based on the benefit that you deserve, the pool of money that you have. So let's say the pool of money is $600,000. That's the pool of money. And you get 2% of that. Well, that would be $12,000 a month that you would get. That's the pool of money that you would get, that you would receive. In this case, the benefit that's coming out is an indemnity benefit with no receipts required. With a reimbursement plan, which most of the other plans are, you actually have to submit an expense, and the insurance company looks at that expense and they say, well, that's a valid one and we'll pay it. Or that's not valid, we won't pay it. With an indemnity plan, they just cut you a check and you do what you want with the money. So think about that. Let's just say, for example, you have a really, really close friend. Your kids are gone and you have a really close friend. And maybe your kids are out of town or they live in another state or whatever. And that friend, you really, really like that friend. You hang out with that friend all the time. And they say to you, if you ever get into a bad situation, I will take care of you. Or let's just say it's your daughter or your son. I will take care of you. And that's usually the way it is. In fact, Right now, 82% of all caregivers are family members. Well, in this case, with an indemnity benefit, you can pay your family members to take care of you and give them a salary. Because what happens is, when family members take care of you, they don't go to work because they can't. Now you're able to pay them and compensate them, and they don't have to be professional caregivers to get paid. They weren't anyway. They were taking care of you anyway. Now you have the option to pay them to take care of you. Let's say you want your kids to come and visit you from California and you live in Florida. You have the cash to do that. You're going to get an indemnity check, a monthly check for a period of time, usually 72 months is what we recommend. And you're going to get that check tax-free every month for 72 months, and you do what you want with it. With a reimbursement plan, you got to actually send in the receipt and say, okay, this is what I have, this is my expense, will you consider reimbursing me for it? And if they will, they'll cut you a check. If they won't, they don't send you any money. But indemnity is significantly better. And so when you're looking at the plans, make sure that you get an indemnity plan. The next question that I get is, tell me about the inflation rider. What is that all about? Since most plans don't have inflation riders, I want to explain to you how significant this benefit is. Now, you can take a plan with or without the inflation rider. But let me give you an example. Let's say you're 60 years old, okay, and you're male, and you have $100,000 that you want to transfer from your left pocket to your right pocket. And remember, it's only a transfer, it's not an expenditure. The asset still is on your balance sheet. Should you want the money later on, you need the money, you can go get it. Your $100,000 would be there for you. Should you pass away and never ever use the long-term care benefit, your beneficiaries would get the money that you put into the plan. So it's not a loss. You're not losing the money. You're just letting someone use the money for a period of time. In the meantime, you're going to have this protection. So let's just say you are part of the group, the 72% of America that needs long-term care. And remember, this is an indemnity benefit, so you're going to get a check. So the check that you would receive, if you did not have the inflation rider, would be $6,688 a month for 72 months, which, if you do the math, comes out to a pool of money of $481,000. So your $100,000 becomes $481,000 immediately. That's the leverage that you're creating. That's the Mickey Mantle leverage that you're creating there, okay? If you add the inflation rider to it, your first year benefit, instead of being $481,000, is $323,000. So 3 times what you put in. But that pool of money is going to inflate by 5% every year. And so by the time you're 85 years old, so now you're 25 years later and you're 85, and that's the time you're going to be using this plan, your pool of money has increased from $100,000 to $1,100,000. Isn't that incredible? In fact, your monthly benefit would be $13,405. Now, I know this is a lot of numbers thrown at you. If you want to know specifically how the return of premium plan would work for you, how it would benefit you, give us a call or go to our website, request a special report, because you're going to want to know all of the details, and get a personalized analysis along a return of premium analysis. Request this and you'll get that, and we'll send that to you at no cost. The next question that I get a lot is, how are most people funding it? Are most people coming up with the lump sum? Well, statistics show that that's true. That's what's happening right now. Most people are coming up with a lump sum of money. But let's just say you don't have a lump sum of money sitting in a CD. And that's the example that I like to use the most. Let's just say you do have a CD and it's sitting in your local bank and you're earning less than 1% in that CD. What's it going to do for your care? How much is it going to provide in care benefit for you should you need it? So let's say it's worth $100,000. How much is it going to give you in care? It's going to give you $100,000. It's going to be valued at what it's worth, and that's it. No more, no less. Had you taken that $100,000 out of the CD and put it into the return of premium long-term care, we know it would be valued at minimum of 3 times. But if you add the inflation rider to it, it'd be 10 times what you put into it. And should you never ever need the long-term care benefit, return of premium comes to you or your family. Well, anyway, back to my question. So how do most people fund it? Well, most people do a single deposit. But what if I don't have the CD? What if I don't have the money sitting in the coffee can in the backyard? What if I have all my money tied up into IRAs or 401ks, pension plans? What if the money's there? And I want this, and I need to have this care, and I get it, I understand it, but I just don't have the liquid cash to fund it. Well, if you're under 70 years old, you can fund this plan over a period of years. 71 years old, actually. So a 70-year-old can fund it over 5 years. And you can choose to fund it over 1, 5, 7, 10, or 15 years. Now, the longer you fund the plan, the less benefits you're going to get, because there is a premium to fund it over a period of time. But let me give you an example. Let's say you're a female 60, and this is in the special report, by the way, that again is available to anybody that calls us or goes to our website and asks for the special report. But let's just say you're 60, you're a female, and you add the 3% inflation that's compounded for the female, and you put in $100,000. Your pool of benefit that you have will be immediately $375,000. In 20 years, that pool of benefit will grow to $659,000. So 6 times what you put in. Remember, you're putting in $100,000. But I don't have $100,000. My money's tied up in the IRA. Well, if you withdrew $17,436 for 7 years, so spreading it out over 7 years, taking out a periodic withdrawal over 7 years, you get the same exact benefit that you would if you deposited $100,000. So that's key. There is a way in which you can do what's called and by the way, this particular feature has only been around for a year now of the multi-deposit option. So it's opening up a lot of doors and allowing a lot of people that want this plan, but frankly don't have the liquid cash right now to dump into it as a single deposit. You get more bang for your buck if you do the single deposit, but you can still get an enormous leverage created. In fact, even more leverage because you're only putting it in over a period of time. Your initial leverage is significantly greater than the single deposit. So the next question that I get is, how can I get a personal example of how the return of premium long-term care plan works for me? Well, that's a great question, because I would like everybody that has any kind of financial means at all, I mean the wealthiest to those that are just getting by, to have at least the knowledge of what this concept is. Because I firmly believe that this concept is going to take the nation by storm. This is a big concept, the strategy of return of premium long-term care. Because in the past, the only way we could ever fund it was to buy a traditional long-term care policy and fork out money, and once it was gone, it was gone. And if we never triggered the long-term care, adios to that money. We never got that money back. Now, if we never trigger it, if we're fortunate enough to dodge the long-term care bullet, we get the money back. And either we get it back or our kids get it back, and or we get it in benefit. But everybody should at least know what this concept, what the strategy, what this idea will do for them, what it would look like for them specifically. And so what I recommend that you do is, of course, read the special report that we have prepared for you. It's called the Return of Premium Long-Term Care Special Report, and it's the answers to today's long-term care crisis. And get that first. Read the report. It's at no cost. Call us on the toll-free number or go to our website. And from there, go to the request for a personalized analysis. I get this question probably the most. How can I qualify? Well, fortunately, this particular plan does not require a medical exam. So you don't have to go down and have blood tests or all those kind of probings and whatever like that. What it is you fill out an application that is an electronic application, so that's pretty easy to do. It's an online application process. And then from there, the insurance company that is offering this plan conducts an interview. And the interview then determines whether or not you can qualify. And they ask you some questions. They do some cognitive tests in the interview, and it takes about 30 to 45 minutes. So that the screening process is significant. I mean, 45 minutes is a long time to be talking to somebody. But you can determine if you qualify without any expense. It doesn't cost you any money to see if you qualify. Now, of course, we can tell just by talking to you sometimes if you can qualify. For example, I had a gentleman call me the other day who had Parkinson's disease. Well, that's not something that you can qualify with if you currently have that. If you're in a nursing home or you're currently using a walker, if you have dementia or Alzheimer's, you're not going to qualify for this. But right now, everybody that we talk to, and most people won't call us if they're in those situations, but right now, only 4% of those that we talk to are disqualified. So the vast majority of the population is going to qualify. It's a lot easier to qualify than even traditional long-term care policies today. And the reason why it's hard to qualify for traditional long-term care policies is because the insurance companies that are offering those plans want to get out of that business because it's a losing proposition for them too. Remember, the return of premium program allows you to transfer your money from your left pocket to your right pocket and have this enormous leverage that's created for you. I am emphatic that this is the best solution to this plan, and I have seen firsthand long-term care in my life. My mother-in-law, 3 years with osteoporosis. My father-in-law, a year with dementia. My brother-in-law, a year with cancer. My father, 7 years with Alzheimer's. I've seen this. I know what it can do financially, and I know what it can do to a family. Now, I want to be taken care of in my home. And my wife has told me, she's 6 years younger than me, Jane has told me that she would take care of me. Well, we'll see. But the key is, wouldn't it be nice that I would have the option? I would have options. If you don't have the means, you don't have the options. And here I would have and even if I'm extremely wealthy, why not reposition $100 from my left to my right pocket for my care? It's a great investment. Do you know that the internal rate of return on this plan is 10%? 10% over 20 years? Well, it was good to talk with you today. I want to ask you the so what, though. So what, I spent 15 minutes with David listening to him talk about the return of premium long-term care. So what? Well, I want you to do one thing. I want you to call us and get the special report. It's free. All you have to do is call 888-892-1102. 888-892-1102, or go onto our website and you can click the link that's attached to this email that's been sent to you today, and click on that website and go there and order the special report. It's at no cost to you, and it explains in great detail exactly what we're talking about. And then take it one step further. Find out for yourself firsthand what it would look like for you if you adopted this, if you transferred $1 from your left pocket to your right pocket, what it would look like for you specifically. At no cost, we'll do that. And you know what? You could even apply for it at no cost and see if it works for you. But that's down the road. Let's at least find out exactly what this is. Return of premium long-term care is absolutely the next phase of financial planning, and it's a logical way in which you can take care of this aspect of your financial plan. Thanks for listening. Have a great day. Take care.